how to calculate DSCR loans. Hey, what's going on, guys? It's Sal Bossio with Mortgage Universe, where real deals get done. I wanted to actually show you guys how to calculate your own DSCR loan. So whether you're an investor or you're new to investing, this is really the tool that you need to determine whether or not a property is going to cash flow. It's really simple. Let me show you. Okay. All right, so we're gonna use a recent example just because it's on the top of my head. A loan I just got cleared to close. It's a $400,000 home. She's putting 20% down, which of course is the minimum. Typically, again, you can do 15%. Those rates are higher, but 20% down. 20% down. Her loan is $320. We have her at an interest rate of 6.75. And by the way, this is a rate with no points. Her term is 30 years, so 360 months. So the principal and interest payment alone automatically calculates. It's right here at $2,075. Okay. Interest only payment technically $1,800, but we're not going to look at that for this example or this video. But we calculate her homeowner's insurance, okay, because we got to add the homeowner's insurance at $150 a month. Her taxes are actually only about, what were they? It was about $23.47 a year, so that is $195 a month, okay? There's no HOA in the property. There's no extra cost. Sometimes you have like flood insurance or property management fees or something like that. In this example, it's very simple. We don't have any of that. We don't have HOA. We don't have anything extra. So her total payment, principal, interest, taxes, insurance, comes to $2,420. Okay, she's actually not impounding. She's not escrowing. So really, she's excited about the fact that she has this type of cash flow. She's going to be paying the mortgage. The insurance and the taxes herself, which a lot of investors like to do. Sometimes they like to impound them. That's fine too. But in this case, we did get a 1007 back from the appraiser. So a 1007 is the form that the appraiser fills out to show us the average market rent for similar properties, and then they determine what the rent of that property is going to be, right? So this property happened to come back at $2,500. So we know that the rent, we're going to put $2,500 for rents used for qualifying, okay? And again, you can do it one of two ways. You can base it off of what the appraiser says, right? However, if she had a rental agreement that showed $2,700 or $2,750, typically you can go off up to 125% of the rental agreement that the borrower has. If they have a rental agreement in place, they might not have one. The easier thing to do is just to treat it as a vacant property because they don't need to have a renter in place before they close. Sometimes they do, and that helps, bring the DSCR up if we need it. But in this case, we didn't. So basically, $2,500 is what the appraisal said, the 1007. So that put us just above 1 on a DSCR. So we're right at ratio, slightly better, which is great. That means that the loan is approved. It's as simple as that. She has good credit. She has the assets, the property cash flows. It's done, right? So now all we have to do is close. We close on the 29th, and that's it, right? It's as simple as that. So I just, I wanted to just really just show you what this looked like, just so you can kind of see how to calculate it. And every example is going to be a little different, but these are really the only fields you need essentially to fill out to calculate your DSCR. It's as simple as that. I had a conversation with a borrower yesterday that she texted me and she says, I just don't think I'm going to qualify. I knew it was an investment property. We had a conversation a month before that she was doing a 1031 exchange to basically buy 3 other properties. She just sold a property in California. She has all this equity. She wanted to put it into 3 other properties so she didn't have to pay taxes on it. And that's what people do a 1031 exchange for. She already bought 2 properties and she had about $150,000 left. And she was like, I'm just not gonna, by the way, she bought those 2 properties cash, obviously, from the equity with the home. She didn't think she had enough money to purchase another property because technically she had to finance some of it. So I said, listen, I was like, why? I asked her, I'm like, why do you think you won't qualify? She's like, my income just isn't there. I'm like, I don't need income. With the DSCR loan, and we had a conversation and I explained to her that she has at least 20% down. In fact, she has 30% down, which helps with the interest rate. But really 25% is really all you need to get the best rate for a DSCR loan. But I was like, we had a conversation and it was awesome. And she's like, I didn't know about this product. I didn't know that this existed. I'm like, well, I'm glad we had this conversation, because now you know you don't have to count yourself out. We can buy this property. Now she's looking at a couple properties to see which one she would work for her. So like a lot of borrowers do not know that this even exists. And that's what I'm trying to do, is get the word out that you can qualify as an investor. It's very simple as long as the property cash flows. And believe it or not, as I've discussed in other videos, even if the property came in short, even if the rental came in short, as long as you have 25% down, typically, again, it's all different with lenders. Sometimes if you have extra reserves, 6 to 12 months reserves, they make exceptions as well. But if the market rent comes in short of what the mortgage is, there are lenders that still do what's called low ratio DSCR, as we've discussed, or as I've gone over in other videos. So you don't have to count yourself out. Yes, it is a little bit of a higher rate because it's a little riskier. It's a lower ratio. For example, if the market rent came in at $2,400 on this property, we see that her principal and interest, tax, and insurance is $2,420 on this property. It would put us, so what we do is we do 2,400, right? 2,400 divided by 2,420, which is the mortgage. And we see that it would come in just short, right? 0.99% is where it would be. So let's just say, I'll go back here. The rent was 2,400 on the appraisal instead. We're coming at 0.99, right? So that's just, some lenders would make an exception, but let's just say the market, the rent came in at 2,200. Now we're at a 0.9, which is considered a low ratio. Some lenders will go down to 0.75. So even if this came back at 2,000 a month, we're at a 0.82, which is still, even though there's no real cash flow on the property, there are lenders that will do these loans anyway. So anyway, the point of this video, we don't have to get into all that on this video, but the point is that I wanted to show you exactly how to calculate. And you can actually, I'm going to provide this link to this calculator in the video description. So you can actually download this calculator, and that will help you determine what kind of property would cash flow. That'll just help you with doing your due diligence and figuring out. And then you can of course call me or text me and I'll help you as well. But at least you'll have this resource now. This is a great tool for investors and future investors. But that's it. Just wanted to discuss that and basically give you my calculator. If you like this video, please go ahead and click like. And if you really liked it and you want to see more, please go ahead and click the subscribe button. And yeah, I'll see you on the next video.